What if the safest investment in the world suddenly wasn't safe anymore? Ray Dalio, the billionaire investor who predicted the 2008 financial crisis, Wood is now sounding the alarm about something even bigger, a potential collapse of the U.S. bond market, and with it, the possibility of a global financial reset. In this video, we dive deep into Dalio's latest warnings about America's skyrocketing debt, eroding investor confidence, and what he calls a financial heart attack waiting to happen. Is this the beginning of the end for U.S. Treasuries? Could the U.S. dollar lose its status as the world's reserve currency? And more importantly, what can you do to prepare? Stay tuned as we break down the risks, Dalio's predictions, and his exact playbook for surviving and even thriving through what could be the greatest financial reset of our lifetime. Let's get started. So, part one. Why are investors losing confidence in U.S. Treasuries? Something that once felt unshakable is now starting to crack. U.S. Treasuries, long considered the safest investment on earth, no longer offer the same sense of security. When Ray Dalio says fear the bond market, it's time to pay attention. Why is confidence slipping? Because investors see the U.S. government borrowing at a reckless pace, over $36 trillion in debt, with interest payments exceeding $1 trillion per year. That's money going just to service debt, not to build the future. The deficit alone has exploded to $1.8 trillion this year. Dalio put it bluntly. The deficit is becoming critical. Without investor confidence, the key foundation for any bond or currency, we risk higher interest rates, volatile markets, and possibly a full-blown debt crisis. Signs are already here. The yield on the 30-year Treasury just spiked past 5%, its highest since 2023. In bond markets, that's seismic. It means investors want more compensation to take the risk of lending to the U.S. It's like the most responsible friend suddenly missing credit card payments. People notice and start to worry. Dalio compared the situation to a financial heart attack waiting to happen. Years of bad habits quietly clogging the system until one day it all stops. He believes we could face a debt crisis within 3 years if nothing changes. The biggest fear, that the U.S. will try to inflate its way out, printing more money to cover obligations. But that devalues the currency, sparks inflation, and makes bonds worth less than the paper they're printed on. This goes deeper than numbers. It's about trust. For decades, the US dollar and treasury bonds were the backbone of the global financial system. But now that trust is eroding. Political dysfunction isn't helping. Lawmakers bicker, pushing the US closer to the edge. Investors see the chaos and ask, why should I keep lending to a country that can't even agree on how to pay its bills? Dalio's message is clear. The clock is ticking. Without action on spending cuts, tax reforms, or both, the crisis will shift from theoretical to personal. And when it does, it won't just hurt Wall Street. It'll hit your mortgage, your savings, your job, your future. Confidence in U.S. Treasuries is crumbling, not because of one bad decision, but because of years of avoiding hard conversations. Now, those can't be avoided any longer. Moving to the part two. What does Ray Dalio really think about the crisis? Ray Dalio, one of the most respected voices in finance, isn't just raising a red flag, he's practically screaming. To him, the risks tied to U.S. government debt are far more severe than credit rating agencies suggest. The national debt has surged past $36 trillion, with the debt to GDP ratio above 122%. That means for every dollar the economy produces, more than $1.20 is owed. A clear sign, Dalio says, that the model is unsustainable. It gets worse. The federal deficit is running at about 6.4% of GDP, among the highest peacetime deficits in U.S. history. If nothing changes, by 2035, a staggering 30% of all federal tax revenue could go solely to interest payments, up from just 9% in 2021. Dalio warns the real threat isn't just the debt size, but how the government may respond. By printing more money, that would devalue the currency, fuel inflation, and most dangerously, erode investor confidence, the bedrock of the bond market. But here's the scary part. There may not be enough buyers, especially foreign investors who've traditionally been major financiers, but are now increasingly hesitant. The political landscape only adds to the risk. Lawmakers are debating whether to extend the 2017 tax cuts, a move that could add another $3.3 trillion to the debt by 2034, pushing the debt to GDP ratio to a record 125%. Dalio doesn't hide his frustration. He sees political polarization and a lack of fiscal discipline as the perfect recipe for disaster. If markets realize the U.S. has no credible plan to manage its debt, it won't be politicians imposing discipline. It'll be the market, through skyrocketing interest rates or a mass investor exodus. For Dalio, this isn't abstract. It's an imminent threat. Institutions like the IMF and CBO have echoed similar warnings. Without reforms, we're heading straight for a fiscal crisis. What hits hardest is Dalio's historical perspective. He's spent years studying how empires fall. Excessive debt, political dysfunction, declining competitiveness, and most crucially, lost global trust. In his words, if the government doesn't make painful choices now, cutting spending or raising taxes, the crisis will force those choices later in a much more chaotic, destructive way. If we don't fix this, the crisis will fix it for us, he says. That's his tone. Not panic, but urgency. Dalio believes there's still time to act, but not much. Will politics shift? Will the markets wait? Or as Dalio fears, will history repeat itself with a superpower collapsing under its own debt? That's the crisis he sees. And that's why the world is paying attention. And now moving to the last part. When will this crisis hit and how can you prepare? If there's one thing Ray Dalio has taught through his decades of research on economic cycles, it's that timing a crisis is impossible, but preparing for it is essential. Dalio doesn't pretend to know the precise date of the next financial collapse. No one credible does. But he does believe that the U.S. is rapidly approaching a tipping point, and the warning signs are already flashing. He often refers to the long-term debt cycle, a pattern that has repeated itself over centuries. Governments accumulate unsustainable debt, monetary policy becomes ineffective, interest payments consume public resources, and eventually a combination of currency, devaluation, inflation, and political instability resets the system. So, when will it hit? According to Dalio, we're in the late stages of the long-term debt cycle. His estimate, within the next 5 to 10 years, though the first major market shocks could happen sooner as confidence erodes and interest costs spiral higher. But here's the critical question. How do you protect your money when the world's most powerful economy is facing a potential systemic crisis? Dalio has laid out a series of complex but practical financial instructions that investors should follow to survive and even thrive through what he calls the big paradigm shifts that occur during such times. Well, the first Ray Dalio's instruction is hold hard assets as currency, confidence declines. One of Dalio's most controversial but consistent recommendations is to own hard assets, things that governments cannot print. In the late stage of a debt cycle, governments often attempt to inflate their way out of debt, essentially devaluing their currency to make their obligations more manageable. The Federal Reserve may be forced to lower real interest rates and monetize debt. Dalio's solution? Own assets that hold intrinsic value. Like gold and precious metals, he calls gold a timeless and universal alternative to paper money. Real estate, especially income-generating properties, can adjust rents to inflation. Commodities, from energy to agricultural products, these rise when currency value falls. These hard assets serve as stores of value when fiat currencies are under stress, as history has shown repeatedly, from Weimar Germany to the stagflationary 1970s in the US. The second instruction is reduce home country bias. Most investors are overexposed to their own country's stock and bond markets. Dalio warns that in a debt crisis centered in the US, this would be catastrophic. His advice: diversify geographically. Hold foreign equities, particularly in countries with strong balance sheets, low debt to GDP ratios, and commodity resources. Consider exposure to emerging markets that may benefit from commodity booms or rising regional influence as US dominance wanes. Hold foreign currencies as a hedge against the US dollar's potential decline. This approach reduces systemic risk tied to a single economy or political system. The third instruction is maintain strategic liquidity for market dislocations. Dalio warns that during crises, markets can become illiquid and volatile, and forced sellers can create once-in-a-generation buying opportunities. But to capitalize on those moments, you need strategic liquidity. This means keeping a portion of your portfolio in high-quality liquid assets, e.g. short-term US Treasuries or cash-like instruments. Avoiding excessive leverage, which can force margin calls at the worst moments, and having the emotional discipline to deploy capital when markets are panicking. Dalio often repeats, the greatest mistakes investors make are to believe that what happened in the recent past is likely to persist. In crises, markets don't move in a straight line. They overshoot. Having liquidity allows you to buy when others are selling in desperation. And moving to the last instruction. Don't bet on one scenario. Build an all-weather portfolio. The name itself gives you a hint. It's all about being ready for anything. Think about packing a backpack for a trip, but you don't know what the weather will be like. It could be sunny, rainy, cold, or windy. So instead of just packing sunglasses or a raincoat, you bring a little bit of everything: shorts, a jacket, an umbrella, and sturdy boots. That way, no matter what happens, you're covered. The all-weather portfolio is just like that backpack, but for your money. It's an investment strategy designed to perform well in any kind of economic environment, whether the economy is booming, slowing down, inflation is rising, or prices are stable. Here's how it's structured. 40% goes into long-term bonds. Think of these like a big warm coat, safe and reliable, especially during tough times. 30% is invested in stocks. These are your sunglasses. When the economy is sunny and growing, stocks help your money grow fast. 15% is in intermediate-term bonds. These are like a light jacket, steady, not too risky, and a good middle ground. 7.5% goes into gold. Gold is like an emergency kit. It's there for you when everything else seems to fall apart, like during inflation or crises. 7.5% is in commodities. Think of these as a multi-purpose tool. Commodities like oil, wheat, and metals tend to do well during inflation. The beauty of this portfolio is that it doesn't try to predict the future. Instead, it prepares for whatever might come, spreading your investments across different assets to minimize surprises while still giving your money room to grow. But let's be real. The annual return of the traditional all-weather portfolio is around 7.67%. That's decent, but if you're looking for a bit more excitement, you might want to add some spice. For me, that means incorporating a small allocation to Bitcoin. Here's how I'd adjust it. But first, let me be clear, this isn't financial advice. You shouldn't blindly follow me. Always study and understand your investments before making decisions. Also, keep in mind that no portfolio is risk-free. Diversification helps reduce risk, but it doesn't eliminate it entirely. Now, here's my version. About 30% goes into the Vanguard Total Stock Market ETF, giving exposure to the entire U.S. stock market. The largest portion, 40%, is invested in long-term U.S. Treasury bonds through the iShares 20-plus year Treasury bond ETF. Another 15% goes into intermediate-term Treasury bonds with the iShares 3 to 7 year Treasury bond ETF. To diversify further, 6.5% is allocated to the InvescoDB Commodity Tracking ETF, which invests in resources like oil, gas, and metals that tend to thrive during inflation. An equal 6.5% is placed in the SPDR Gold Trust, a classic hedge against market volatility. Finally, I add a small 2% to Bitcoin, giving the portfolio a touch of innovation and exposure to the rapidly evolving world of digital assets. In 16 years, this portfolio grew by 16.11%. Even with inflation, the return is still impressive, 13.19%. If you had invested $100,000 in this portfolio 16 years ago, today it would have grown to $116,110 in nominal terms. And if you had invested $100,000 initially and added $1,000 each month, it would have grown to $1,980,732.98. Well, that's it, cousins. Stay invested.